Well, when it comes to maximizing the value of the business, I think we all have to take one step back. And one of the things I'm really keen on doing is educating my clients all about the aspects of valuation. So one of the first things that happens when I meet somebody new and I'm prospecting, they'll say, well, hey, I'm thinking about selling. Should I go get a valuation done? No, absolutely not. Like, why? I said, well, let me explain what a valuation is. A valuation report is theoretical. And it starts off, every one of them, I used to write them, and I've had many done for my own companies, but there's a reason. It starts off by saying value is what a at arm's length third party would pay for a business if they had all the available information. So the only way that ever happens is if somebody actually buys the business. That's reality. You only know what the value is if a transaction goes through. So why would anyone get a valuation? Okay, first, if you're going to say take the ownership of your company and move it into a trust, when you do that, you're definitively going to want to have a valuation because the IRS might challenge the valuation. In that case, you're trying to push the value down to get within the threshold of whatever you need to get it inside of that trust on a tax advantage basis. So you're going to need a valuation person who's really good in front of a court and a jury, because they're going to be your expert witness explaining how they came up with their valuation. So the more times they've been to court and the better they are in front of a jury or a judge, that's why you want that. The exact same thing's going to happen inside of, say, a partnership issue and you need a valuation done. Let's say they dispute it. Well, now you're going to have to go to court again. So you're going to need that valuation to be defensible. Same thing, say, in a divorce. I had a divorce. I had to get all my businesses valued, and they're all not public, they're private. Well, so my ex-wife had her valuation experts. They pushed the value up, and my experts were keeping the value down. And then we were in front of the judge, and well, that's why you get a valuation done. When it comes to actually thinking about the reality of when you go to sell the business, what is going to drive the value? Okay, really crystal clear formula. The formula that's going to be used when someone buys your business is going to be the buyer's perception of the risk-adjusted present value of the expected future cash flows. All right, let's break that apart and let's look at it. Buyer. So first thing that's going to impact the valuation of your business, who's the buyer? You're going to have really sophisticated buyers that are private equity firms. And by the way, some of the dark arts. Later, I can tell you exactly how to get them to overpay. There's a secret. But the buyer, if you get an unsophisticated buyer, they might overpay or they might not know how much to pay. So it can be more challenging to deal with somebody who doesn't understand the techniques of valuation and doesn't have good advisors. So dealing with a sophisticated buyer is easier. They know what they're doing, but you might not get all the value you might from someone that's not as sophisticated. So buyer matters. The perception of the buyer. So buyer's perception. How do we shape perceptions? We were talking about that earlier. It's like the hall of mirrors. How do you create the belief? Well, there, you, in a way, have got to create the element in your story and credibility of there being scarcity. So the perception of it has to be that if I don't move, somebody else will, and I'm going to lose out on this. Fear of missing out, FOMO. So buyer's perception, okay, of the risk-adjusted. Now, risk is by far the biggest overall factor in evaluation, because just think about it. Risk is reflected in interest rates, right? So if I'm a really good risk, the bank will loan to me at prime or the least amount. We all know that if we're a bad risk, we're going to go all the way up to subprime where we might have to pay 20%. We know that people that have bad credit pay more in interest rates. That's because they're riskier. So interest rates and risk are directly correlated. Valuation multiples are inversely correlated to risk or interest rates. So the lower the interest rate or lower the risk, the higher the multiple. The higher the risk, the lower the multiple, meaning the less they'll value it because they need to compensate them for more potential risk of it not working out. So risk is also about the economy. So if we just start and say if it's 2008, the Great Recession, banks were just clamoring to get back their capital to stay alive. Some banks went under. What they had to do was just stop letting lines of credit go out. And many good businesses, friends of mine that had never violated a covenant on their banking terms, ever. And they were doing great. All of a sudden had their line of credit pulled by the bank, putting them in jeopardy because the bank needed to pull back the reserves because of bad loans the bank had made. So that was a big risk. We think borrowing money, yes, it's risky, but you never think about, and most people don't go back and remember what exactly happened in '08. But that's the point. Risk to the general economy will impact the stock market. If it impacts the stock market, if interest rates are going up because of inflation, well, there's going to be less merger and acquisition activity because big buyers use debt. Debt increases the cost if interest rates are higher. So the overall economy and the availability of capital, again, that's all risk related, impacts valuations. So all the way down when people are looking, risk is the single biggest factor in driving a valuation. There's also a perception of size of a business, bigger with more customers spread out across many things, different lines of revenue, bigger geography, is perceived as being less risky. So a small company that has a couple of customers, small amount of revenues, and a high concentration of those revenues within just a few, that's riskier because if they lose that customer, the business goes away. So size is again about risk. So those are some of the factors. Now, after you go risk adjusted, you go present value. So one way or the other, whether people recognize it or not, they're going to look at, just because all assets and all financial products, everything is valued on a perception of that stream of cash flows in the future, bringing it back to the present value. So there's a formula just about interest rates. What's something worth today is not the same thing as what it's worth tomorrow. We know that with the recent inflation. If I had, and I'm retired and I have fixed income, going to buy milk for $1, okay, that's in my budget, and I get $100 a month. So 1% of my budget goes to milk. If milk jumps to in the price in 3 years to $1.50, well, now milk is taking up much more of my budget. So everything that goes up in inflation, that's really what we're looking back to discount. So we know what the value is today based on how things will happen in the future. Okay, CPI. So present value. So now we've gone the buyer perception, risk adjusted present value. There's a formula for that of the future stream of cash flows. Okay, future stream is all the things that could happen. So again, what's going to impact the valuation? If your revenues are going up on a trend and have been going up, and when you meet with a prospective buyer, you can show them your CRM, customer relationship management system, and your sales leads gen, and you've got this funnel that's been working, and you can predict that you've got a bunch more revenues coming in the next year and the year after that, and you've got recurring revenue streams, and you're thinking, well, that future cash flow is more certain. So that looks really good. Cash flow is really after revenues and expenses, you have operating cash flow. People use the term EBITDA, and I have a whole separate video on EBITDA, but it's not an accounting term. It's not a generally accepted accounting term. It's actually made up. Now, why? Well, because it's earnings before interest, depreciation, tax, and amortization. Okay, why? Well, because tax might have tax loss carry forwards, might not. Taxes, everybody's got a different tax rate. So can't care about that. Why interest? Well, because paying a bank an interest rate versus paying a dividend to an owner is the same thing. One way or the other, they've got a claim on the asset. So your interest rates could differ, your line of credit could differ. So you want earnings before your interest as well. Depreciation is about how much you've invested, and then the tax allows you to depreciate so that you can write that off as an expense on your balance sheet. Well, it's not a cash item. It's just a metric to show the depreciating value of your assets. But a lot of times what the IRS or other people allow you to depreciate at, or the rules of accounting, have nothing to do with what's real in reality. Like a pipeline, you put a big pipeline, it costs you a lot of money and you get to depreciate a certain amount of it, say over 20 years, that pipeline might last 50 years. So yes, you got to reinvest in it and with a capital thing, but when you do that, you could go borrow the money. So depreciation doesn't matter. Amortization is really about intangibles like goodwill. Say you buy a company for more than the book value, that increases goodwill. Well, everybody's got a different amount of goodwill and it's non-cash. Same with you've got intellectual property. You're going to allow to take a amortization of the value of that intangible asset of your intellectual property. It's non-cash. So again, earnings before those things, because that's how much does your business generate in cash flow to be able to pay a bank or lenders if you wanted to use them, and to dividend out to owners who can then pay the tax. So that's why EBITDA is used. It's a proxy for operating cash flow. So why all that information? Because cash is king. Today, tomorrow, and every day until you sell. You want to make your decisions to absolutely drive more short, medium, and long-term cash flow. Focus on the long term, don't forget about the medium term, and don't shortchange yourself on the short term. So when you, again, go back and find money that you're unnecessarily and unknowingly giving away, when you do that, you immediately can put more cash in your pocket or reinvest in your business to increase its value. So therefore, to increase the value of a business, both today, tomorrow, in the medium term, and the long term when you go to exit, what Wealth Creator Coaching does is we do decision optimization coaching. We do employee loyalty programs. We do exit coaching, and we have a vault of wealth, which is all of our tools and all the cool stuff we've developed over the years that we've seen work to help companies do those things and increase the value of their business. Let me go through them one at a time. When we look at decision optimization, we spoke about it earlier, it's really about making excellent decisions that increase the value of the business in the short, medium, and long term, and not give away money unknowingly and unnecessarily, to make more objective decisions than subjective decisions, to make more holistic decisions than silo-based decisions. So that's the thing we're looking at doing. Right? And I'll stop for a second. If you think about your business as a raw diamond, because it is, it could become the most valuable business in the world. Other people have, so why not you? To do it, you have to take the raw diamond and make it valuable. You have to have it cut. And when they cut a diamond, they call them facets to create all the prisms and everything else. Well, your business is the same thing. You've got to make sure you've got a good architecture of when you cut or make a decision in one area and on one facet, holistically, it'll all come together. So that's what decision optimization coaching is all about. The second thing that we do is employee loyalty programs. So why? Well, when I first starting out, one of my mentors, actually it was when I was younger and I was thinking about becoming an entrepreneur and really wanted to. And I said, what's the secret to being successful at business? And one of the first billionaires in the world, actually at the time, and first one I ever met, said to me, Pierre, business is really simple. It's just solving problems. And I already know you're a good problem solver. But people are difficult. Employees, customers, suppliers, partners. That's what you've got to go focus on and figure out. Because if you can figure out people, then you could be successful at business. Wow, was he ever right? I heard that 40 years ago, and it is more true today than ever. So what I, in all of my entrepreneurial endeavors, have figured out is systems that align the interests of my key employees with mine as an owner. And I've taken that program and I've run it through a number of clients, and it's been really popular. And why? Because employees are the single biggest expense on most every business P&L. Employee benefits, the second biggest one. When you take all in and what we pay to the government, the commission that we pay them for the opportunity to hire people, well, we have our biggest expense right there. Wealth Creator Coaching's employee productivity and alignment programs, we help business owners maximize the alignment and the productivity out of the employees that they've hired. We help them hire better. We help them manage better. We just take a whole bunch of that pain out of it. Because quite frankly, I think of business as a game, and games should be fun. And for myself, some of the biggest employee challenges I had made it at times feel really not so much fun. So that's one of our primary objectives, is to drive more fun and more productivity and alignment and make everything easier so that business owners can enjoy more cash flow today, valuation today, all the way until they want to sell it. The third service that we have is exit coaching. And that's one of my favorites because it involves lots of dark arts and science. So I see myself, and it's been described to me as the deal whisperer. I think of the game of selling your business like an incredibly sophisticated game of poker. Problem for most people is that they play poker a little bit, but they haven't played all the different rules or all the different games. I mean, there's literally, I think, 180 different forms of poker and probably more. Most people have only seen on TV one version. So when you go to play poker, if you're sitting at the World Series of Poker and you've got professionals against you, they know what they're doing. The problem for most of us who don't play professionally every day and at that level is that we might make bad choices as to how we play the cards. Because I've done literally hundreds of merger and acquisition transactions in my lifetime worth billions of dollars, I've been at the table. So what I do is I whisper into the ears of my clients how to play their cards on every hand so that they can maximize the value of their business, how much they get paid, and they can get the best terms. Terms often matter a lot more than price, and people will be really shocked. But what's in the agreement and how they structure it is as important as the price. So exit coaching, from soup to nuts, we come in, we help. One of the things we do is we recommend that people hire an investment bank. Hire somebody that's got deep connectivity to the main buyers in the industry. And why is that? Because that reduces the perception of risk. Remember before, risk influences price? If the buyer knows the advisor, the investment banker in the space, and they've checked the boxes of doing their own due diligence and lining it up, that makes it seem safer to the buyer to pay more. If it's safer, they will pay more. So, why would you keep paying me if you're hiring an investment bank who could guide you? It's simply because the investment banker, because they're in that space and keep selling businesses to these types of buyers, while they're not always going to have the time to give you all the information you need when you need it to get the best deal for you. They may not care about that last million because their portion of it isn't that big comparatively. You care. They may not care as much once they get to the bigger numbers. It's here and there. I care because for me it's a game. I want to help you maximize that price and play the game right. So that's why you would want to hire an investment bank and us. We'll show you which ones, how to go find them, how to negotiate the deal, and we're with you the whole way until the deal is done. And then the final thing that we do is we offer this vault of wealth. We have a bunch of tools in there that just systems. One of them's for helping you make better choices when you hire. How do you go about hiring? What's the process? The second one that I can think of right off the top of my bat is a format that teaches everybody in your organization how to write down what the problem is and from the bottom up tell you what the recommended solution is and why and what are the alternatives. It helps better critical thinking. It helps make more objective decisions. It's just a better way of doing things. So we have a whole range of tools that we help our clients with. If you're interested in learning more about Wealth Creator Coaching and our services, go to our website, wealthcreatorcoaching.com, and click the Book a Call button. We'll schedule time to find out whether we're a good fit to work together, and we'll go from there. Thank you very much for listening.